The second setup I usually apply right after the market made the first move, and there is the so-called pullback or retracement, which gives us the opportunity to sell at a higher price or to buy at a lower price, respectively, if the first move is on the upside. So again, you need to make sure that you are selecting the best currency pair on the Forex Profit Supreme meter. You need to look for the daily trend on the higher time frames to confirm the direction of the move and to risk 1% per order. And why I've written per order is because if you enter 2 or 3 times using the Fibonacci retracements, you can increase the risk to 3% from the account if you enter the same amount on every retracement, or you can risk totally 1%, and let's say you sell 2 times at the retracements, you can just sell using 0.5 lot or 0.5%. Alright, then with one of the retracements I would target the 100 level, or this is where the price stopped with the first move, and quite often the price will not continue lower and we will see no more momentum. And especially if the price fails to take this 100 level or the lowest point, I would take the profits from the other trades as well whenever the price reaches closely to the 100 level. Okay, if we see an impulsive break, we can target the 161.8 Fibonacci target, and of course if it is a very strong move and you have selected the top mover during the session, you can target the next Fibonacci target, or you can trail the stop loss behind the recent highs or the recent lows. And if you see change in the Forex Profit Supreme meter, if for example you went short in euro yen and then you see that euro goes above the yen, probably it is time to close the trade and take any profits you have in the account, just to make sure you're not losing them. A few tips: stop loss, keep it at a safe place above the recent highs or above the opening of London for short trades, and enter 2 or 3 times at the retracements. Again, it depends on your money management and how much you want to risk. Maximum fib size is 100 pips, so if the first move is really huge, above 100 pips, I would not use the Fibonacci because already 100 pips are done. And at the same time, if the first move is very small, below 20 pips, I just wait a little bit longer to see a bigger move, because if the currency pair doesn't make 20 pips after the market opens, probably it's not gonna be that strong. Okay, if it does just 10-15 pips, that's not the volatility we want to see, and I wouldn't be having Fibonacci retracement setups. And the easiest way to apply the second setup is if you use pending orders, and you have 2 options. If you see the retracement starting, you can place sell limit orders at the Fibonacci retracements, or if you see the price already above the levels, you can place sell stops at the 38.2, the 50, 61.8. So you will make sure that you are not missing those levels. And if you wait for the price to go above the retracements and then place sell stop limit orders, you will get a better price because you will start selling from the 38.2, for example, right? However, if you don't place before that the sell limit orders, you are taking the risk that the price might not go above the 50 or the 38.2, and it will just continue lower and you will miss the entries. Okay, so these are 2 different options. You can put quickly the sell limit orders, so you'll make sure that you will enter if the price reaches the retracements, or you can wait for the price to go above the retracements and use the sell stop orders. But again, in the second scenario, you are taking the risk that the price might not reverse that high and you will miss the entries. I will leave it on you to decide what type of orders you are more comfortable with.